Imagine it's October 1930. You're a grain farmer in a rural area. You've worked this land for 30 years. Last month, you sold your harvest and deposited the money you earned hard into the First National Bank of your small town. That money represents an entire year of work. It's your seed money for next spring. It's your family's survival through winter. On Tuesday morning, you drive into town to withdraw money for supplies. There's a line outside the bank, a long one. People are murmuring. Some are shouting. The doors are locked. A handwritten sign taped to the glass reads, "Closed until further notice." You push to the front. You knock on the door. A bank clerk inside shakes his head, won't make eye contact, and walks away. Your money is still inside. You can see the vault from the window. But you will never touch that money again. Not $1. The bank has failed. Your deposit is gone. There's no insurance. There's no recourse. There's no appeal. Within 2 years, thousands of banks will close their doors exactly like this one. 1/3 of all the money Americans thought they owned will simply vanish. Not lost in the stock market, not gambled away. Deposited, trusted, and then erased. This is documented history. And the reason it matters now is because the legal and structural conditions that made 1929 possible have not been eliminated. They have been obscured, rebranded. But the fundamental architecture remains the same. Similar happened in the EU during the financial crisis. Similar can happen again. Once you see the pattern, you can't unsee it. Part 1. You don't own your deposit. You are a creditor. Let's begin with what most people believe. The common assumption is that money in a bank is safe. It's there. It's yours. You can access it anytime. The building is solid. The vault is thick. The government insures deposits. The system has been fixed since the Great Depression. That was almost a century ago. Surely we've learned this. Belief is the product of careful design, not careful banking. Careful messaging. The truth is more uncomfortable. When you deposit cash into a checking or savings account, you are entering into a contractual agreement. The bank takes your money and in exchange issues you a liability. That liability says the bank owes you. But the cash itself now belongs to the bank. It becomes part of their balance sheet. They can lend it, invest it, lose it. You are now a creditor waiting to be paid back. Most people don't realize this because the system works seamlessly 99.9% of the time. You swipe your card. The money appears. You transfer funds. They arrive. The illusion of access feels like ownership. But there is a difference between access and ownership. Access can be revoked. In bankruptcy law, depositors rank below secured creditors, below derivative counterparties, below many other claims. If a bank becomes insolvent and is liquidated, depositors may receive pennies on the dollar, or nothing at all, depending on what remains after senior claims are satisfied. You might say, but we have deposit insurance, the FDIC. That's true, and we will examine exactly what that means. But first, let's return to 1929. Part 2. Fractional Reserve Banking, the Machine and Its Fatal Flaw. The crash of October 1929 is remembered as a stock market event, Black Tuesday, the Dow falling 12% in a single day, headlines, panic, brokers jumping from windows. But the real economic devastation didn't come from the stock market. It came from the banking system, and it came slowly. In 1929, the United States had roughly 25,000 commercial banks. They operated under a system called Fractional Reserve Banking. Here's what that means. When you deposit $1,000, the bank doesn't keep $1,000 in a vault waiting for you. It keeps a fraction, maybe 10%, and lends out the rest. That's $900 now out the door, issued as a loan to someone else. That borrower deposits their money into another bank. That bank keeps 10%, lends out the rest. The cycle continues. $1,000 in original deposits can generate $8,000, $9,000, even $10,000 in total credit across the system. This is called the money multiplier. It's how modern banking creates money. It works beautifully in calm conditions. Everyone trusts the system. Withdrawals and deposits roughly balance. The bank earns interest on loans and pays you a fraction of that interest. But the system has a fatal vulnerability. If too many depositors want their money at the same time, the bank cannot pay. The money isn't there. It's been lent out. The loans are long-term. The deposits are short-term. This is called a duration mismatch. And in 1930, it began to unravel. The first wave of bank failures hit in late 1930. A single large bank in New York, the Bank of United States, collapsed in December. Despite its name, it was a private institution. It had over 400,000 depositors. When it failed, rumors spread. Confidence cracked. In small towns across the Midwest and South, depositors began to worry. They started withdrawing their money, just in case. But just in case became a self-fulfilling prophecy. When enough people withdraw, the bank runs out of reserves. It fails. And when one bank fails, depositors at nearby banks panic. This is a bank run, and in the early 1930s, it spread like wildfire. Between 1930 and 1933, more than 9,000 banks failed. Total deposits wiped out exceeded $7 billion, well over $140 billion in today's terms. These weren't speculative losses. These were savings accounts, business accounts, payroll accounts. The money people thought was safe. You didn't invest, you didn't gamble, you did the responsible thing, you saved. And the system erased it. Confidence is the load-bearing wall. The moment enough people doubt the system collapses under its own mathematics. Part 3. The FDIC illusion. 1.1% coverage for $10 trillion. In 1933, the U.S. government responded by creating the Federal Deposit Insurance Corporation, the FDIC. This was meant to restore confidence. If your bank fails, the government will reimburse you up to a certain limit. Originally, $2,500. Today, $250,000. Most people believe this solves the problem. Let's examine that belief carefully. The FDIC is an insurance fund. Like all insurance funds, it has a balance. As of 2023, the Deposit Insurance Fund held roughly $116 billion. That's the pool of money available to cover failed bank deposits. Total insured deposits in the U.S. banking system exceed $10 trillion. That means the insurance fund covers roughly 1.1% of insured deposits. The system is not designed to survive a systemic crisis. It's designed to survive isolated failures. One bank here, one bank there, scattered, manageable. If multiple large institutions fail simultaneously, the math doesn't work. The FDIC would need to borrow from the Treasury, which means the Federal Reserve would likely need to create new money. That's not insurance. That's a bailout. When Silicon Valley Bank collapsed in March 2023, roughly 94% of its deposits were uninsured. The government intervened and made all depositors whole, but this was a discretionary decision. There was no legal requirement to do so. If your bank fails tomorrow and your deposits exceed $250,000, what happens? The answer is, it depends on who's in charge, what the political calculus is, and whether the failure is deemed systemic enough to warrant intervention. That's not safety. That's uncertainty with a veneer of confidence. Part 4. The Bail-in Blueprint, Cyprus, 2013. And what came next? In 2013, Cyprus experienced a banking crisis. The two largest banks were insolvent. The EU, the ECB, and the IMF imposed a bailout, with conditions. For the first time in modern Western banking, depositors were directly hit. Not through inflation, not through devaluation, directly. Deposits over 100,000 euros were forcibly converted into bank equity. Some depositors lost 47.5% of their uninsured balances overnight, without warning. This was called a bail-in. In a bailout, the government injects money to save the bank. Taxpayers pay. In a bail-in, depositors and creditors pay. Their claims are converted or written down to recapitalize the institution. After Cyprus, the European Union formally adopted bail-in rules as part of the Bank Recovery and Resolution Directive. The United States has similar frameworks under Dodd-Frank and the Orderly Liquidation Authority. These rules are not emergency measures. They are the preferred resolution mechanism. Regulators view bail-ins as preferable to taxpayer-funded bailouts. The political cost of bailing out banks is enormous. The political cost of quietly haircutting depositors is much smaller, especially if those depositors are corporations, foreign entities, or the wealthy. The language is modern. The structure is old. Part 5. 2023. And the hidden losses, SVB, unrealized risk, the impossible trap. Silicon Valley Bank held over $90 billion in securities. When rates rose in 2022 to 2023, those securities lost market value. When depositors wanted their money, the bank was forced to sell at a loss. The losses triggered panic. The panic triggered a run. The run triggered collapse. This happened in 48 hours, the second largest bank failure in U.S. history. The Federal Reserve created emergency facilities to stop contagion. The Bank Term Funding Program allowed banks to borrow against underwater securities at face value. This prevented immediate collapse, but did not resolve the underlying losses. The losses are still there. They are just hidden. As of mid-2023, unrealized losses in the U.S. banking system exceeded $500 billion. And here is the constraint. If inflation persists, the Fed must keep rates elevated. That keeps the pressure on bank balance sheets. If the Fed cuts rates to relieve banks, inflation may reignite. The dollar may weaken. There are only two paths. Neither is painless. That's the trap. Part 6. The Pattern Across Time, 1929, 2008, 2023. History doesn't repeat, but it rhymes. In 1929, people trusted banks because banks had always been there. Failure was unthinkable until it happened. In 2008, people trusted mortgage-backed securities because they were rated AAA. Failure was unthinkable until it happened. In 2013, people trusted European deposit guarantees. Failure was unthinkable until it happened. In 2023, people trusted regional banks because they were regulated. Failure was unthinkable until it happened. Each time, the system found a way to reassure. Each time, the reassurance was partially true and partially illusion. Deposit insurance exists, but it has limits. Regulation exists, but it has gaps. Central banks exist, but they have constraints. In every banking crisis, the cost is distributed, but not evenly. In 1929 to 1933, the people who paid were small depositors in small towns. They had no political power, no legal representation, no access to insider knowledge. They trusted the system, and the system failed them. The wealthy, in many cases, saw the signs earlier. They moved money into government bonds, into gold, into safer institutions. They had options. In Cyprus, it was the same pattern. In Argentina, in 2001, the government froze all bank accounts in what was called the corralito. Peso deposits were forcibly converted to devalued currency. The middle class saw their savings evaporate. In each case, the people who paid the price were those who trusted the system without understanding it. Those who assumed safety. Those who didn't ask questions. The system does not protect the uninformed, it extracts from them. Closing. The question is not whether you trust banks. The question is whether you understand what a bank actually is. A bank is not a vault, it's a counterparty, and counterparties can fail. Those who understood this in 1929 held cash, held gold, diversified, reduced exposure before the doors closed. Those who didn't understand lost everything. The mechanisms haven't changed, only the names. Deposit insurance is confidence management. Bail-in authority is loss distribution. Emergency lending facilities are system stabilization. When too many people want out at the same time, not everyone can get out. The question isn't if the next crisis will come. The question is whether you understand where your money actually is when it does. Most people never study the mechanics of failure until they're living through one. This channel exists to examine the autopsies while there's still time to learn. The past is not finished. It is working, and so are we.